Trump's tax bill just passed, and for real estate investors, this could be the biggest wealth building opportunity of the decade. I'm Dr. Jeff Anzalone, and in my last video, I broke down how Trump's big, beautiful tax bill could actually make real estate investors millions. Now that it's law, the real question is, what would you actually do right now to build wealth and take full advantage of these new tax breaks? But before we dive in, know this: every bit of freedom that I've built, cash flow, free time, and passive income, comes back to my 7 WOW or work optional wealth steps. It's the system that I use and you can too. Download the free guide below. Now let's break down the key moves every investor, not just real estate investor, but every investor out there should do to maximize returns, cut taxes, and build real freedom while we have this window open. Let's get going. Now, let's talk about probably the game changer in this whole bill, especially for real estate investors. And that is this. You probably know where I'm going with this. The 100% bonus depreciation. It's back. Now you're probably thinking, well, what does this mean? Well, this means if you buy the right kind of real estate, you can write off a huge chunk of your investment, sometimes 25% to 40% or more year one. So instead of waiting 27 and a half or 39 years to get your tax benefits, you get them up front. Now, I'm a general partner in the Blue Metric Group. We buy and improve RV parks and mobile home parks all over the country. Now, when we buy a new park, we do what's called a cost segregation study. That's just a kind of a fancy way of saying we break the property into parts: roads, pads, buildings, landscaping, and more. With 100% bonus depreciation, we can now go in and write off all what's called the short-lived parts, like roads, parking pads, appliances, and more right away. So for example, on like $1 million park, we might be able to write off $300,000 or more in year one. So if you're in a 37% tax bracket, that's over $100,000 in tax savings, money you keep instead of sending it to the IRS. Well, if you invest in one of our RV park syndications, and if you're a accredited investor, you actually get to share in these tax benefits. A syndication is just a group investment. Lots of people, general partners, limited partners, they pool their money in together to buy a bigger property that they previously couldn't buy on their own. So if you're a passive investor, you don't have to manage anything. You just invest and you get your share of the cash flow and the deductions. So here's how it works. We find and buy the park. We do the cost segregation study and use bonus depreciation. You, as an investor, you get a tax form called a K-1. We send it to you, you send it to your CPA, and basically what it does, it shows your share of the paper losses that you get from investing in a property. Those losses can offset other passive income and sometimes even your regular income if you are what's called a real estate professional. Ask your CPA if you need help. This isn't investment advice. This isn't tax advice. So again, if you invest in a syndication, you get cash flow every quarter. You can get big deductions now, especially now up front, and you don't have to be a landlord and deal with tenants. Okay. Now, if you're a accredited investor and you want to learn more about our opportunities, we have a passive investor link. I'll put it in the description below. Let's move on. How you can continue to maximize your wealth with this new tax bill. So we'll label this number 1. Number 2, let's talk about the Section 179 deduction. Now, this is expanded. So with this expanded deduction, you can write off more of your improvement or equipment costs right away. Let's say you're like me and you own a dental practice and you decide to buy, a new digital x-ray machine for $100,000. Thanks to the expanded 179 deduction, you can deduct the entire $100,000 in the year that you buy it, instead of spreading that deduction out over several years. That means you can lower your taxable income immediately, keep more cash in your business, and reinvest those savings to grow even faster. Number 3, let's talk about the opportunity zones. The new law brings back opportunity zones, which let you defer and potentially eliminate capital gains taxes by investing in designated areas throughout the country. So for instance, if you sell an asset like maybe stocks, business, or even a property, and you make a big profit, you can reinvest that money into an opportunity zone fund. If you hold that investment for 10 years, you can actually pay zero tax on the appreciation. So imagine you sell, let's say, a rental property and you make $150,000 profit. So instead of paying taxes on that gain this year, you take that $150,000 profit, you put it into an opportunity zone project. And let's say that investment grows to $300,000 or it doubles over 10 years, you could pay zero tax on that extra $150,000 you made. So if you're planning to sell an investment or property or something like that in the next few years, start researching opportunity zone funds, and just as important, talk to your CPA about how to roll your gains into one if you decide on doing that. That could be a powerful way to grow your wealth tax-free. Number 4, you can maximize the SALT deduction if you qualify. So the new law now raises the cap on state and local tax deductions from $10,000 to $40,000 for people with income. So this is for people with income under $500,000. Let's say you live in New Jersey and you pay $25,000 in state and property taxes each year. Well, before you could only deduct $10,000. Now you can deduct the full $22,000. You can deduct the full $25,000 because that's what you're paying. Okay. So that could save you a lot of money in federal taxes, especially if you're in a high tax bracket. All right. Number 5, you can actually optimize your business structure for QBI. The new law makes the QBI, or the qualified business income deduction, even better. Now you can deduct 23% of your business or rental income if you own properties through certain structures like an LLC or direct ownership. If you're earning money from rental properties or a business, you could get a big tax break just by having the right setup. So let's say you own a small business or a rental property through an LLC and you make $80,000 in profit. With this QBI deduction, you can now deduct 23%. So if you take $80,000 times 23%, so now you can deduct $18,400 from your taxable income. Okay. Again, get your CPA involved to set this up. Let them see what your structure is now, and then maybe you could restructure it to take advantage of it. Next is number 6. Next, we're going to talk about plan for your family and your legacy. The new law increases the estate and gift tax exemption and introduces new child savings accounts, making it easier now that you can pass on your wealth to your family. So you can give more money to your kids or grandkids without paying gift tax. And you can set up special accounts for children that are born between 2025 to 2029 with a, check this out, $1,000 government match. That's right. So if you want to help your grandkid get a head start, you can open up a new savings account for them. Contribute up to $5,000 a year, and the government is going to tack on $1,000 to that account. Plus, you can actually now give larger gifts or leave a bigger inheritance without worrying about estate taxes. Again, get your CPA involved if you have an estate planner about updating your will or trust, and consider setting up these new accounts to take advantage of these benefits. Now, while I focus on real estate, it's important to realize this new bill, it impacts everybody's wallet, not just investors. The higher standard deduction, increased SALT cap, and new senior bonus depreciation means that high income earners and retirees can actually see more money in their pockets. That's extra capital that you can put to work in real estate, businesses, or other cash flowing assets. Now, with all these new tax changes, the thing is, having a real plan is more important than ever. Whether you're 30 years from retirement or you're already there, clarity and confidence come from knowing how all these changes are going to affect your bottom line. Don't just hope for the best, run the numbers. Get your CPA involved. That's why you pay them. And make sure that your strategy now is up to date. So don't just go out there and celebrate all these tax cuts. Actually use them. Remember, take that extra cash you save, put it to work to generate income and grow your wealth. That's how you make the most of this once in a generation potential opportunity. Now, I mentioned about real estate syndications a little bit earlier. If you're not really quite sure about how those work, you want to learn more? Great. I've got a video just for you.